My name is Darren Joseph from HTJ.tax. We're the team that seeks to demystify the sometimes confusing world of cross-border taxation for private clients. And today we have the honor and the privilege of having a conversation with the one, the only Leonardo Marquez dos Santos. Leonardo, please, could you introduce yourself?
Thank you very much for having me, Darren. I'm a tax lawyer based in Portugal, partner of Miranda and Associates, also tax law and international tax law professor here at Portuguese Catholic University. That's it.
Wonderful. The taxation of U.S. pensions and Social Security.
Ouch. I'm going to see it. I'm going to explain the way I see it. Portuguese personal income tax code was prepared in the 80s, entered into force in 89. And so the rules are prepared for taxing Portuguese pensions. All right. And Portuguese pensions are paid by a Portuguese public institute, which is the Social Security Institute. So you make contributions. The employee bears a portion of those contributions. The employer pays another portion of that. And the income, when you reach retirement age, you get your pension, and your retirement pension will qualify under personal income tax. Remember those 6 boxes I've told before? It will qualify as pension income. That's it. Top. Pension income is taxable at progressive tax rates, so very high. It's not very high because pensions in Portugal are very low, so there's that. But the tax rates can be progressive and can go very high. Our marginal top rate, which applies over 250K, it's 53%. Okay, 250K for Portuguese resident is considered very high. I think it would be middle class in the US. I've heard some statements by President Biden. Well, I'm not sure, but I think there should be a gap in so 250K per year is very high here. Still, that 53% is very high. I mean, we are the 7th highest personal income tax rate in Europe. 7th out of 27, so it's very high. I'll explain then. This is very high, but there are various exceptional regimes, but we'll come to that in a second. So pension income, when you're retired, it's prepared to be pension income. So if you look at other countries, then the confusion will be created. Why is that? Because we won't find necessarily a social security institute which is similar to ours. Sometimes mandatory contributions are paid by private schemes, not by public institutes. So it starts. And why is that? Because pension, the word pension in Portuguese, pensões, may be taxed as employment income, as capital income, and as I said, as pension income. So what changes? If you have a state pension, the equivalent of the Social Security, and you are paid upon retirement, you should qualify as pension income. That's it. That's what we will. I mean, it qualifies for treaty purposes as pension income, etc. But then, let's say you have an additional pension, which is fed by contributions paid by your employer. So your employer is a very nice guy. He says, "Well, I know your pension is going to be awful, so I'll just, in addition to what you're going to receive and the contributions that I have to make to Social Security here, I will pay an extra, and I will pay it to a private pension scheme, which is sort of a financial product. It's not a Social Security, it's a financial product. And that amount may qualify as employment income in 2 cases. If you have what is called acquired rights, if you change that job, if you leave that company and move to another one, and you're still entitled to that amount, like sort of the fund or the pocket that belongs to you, this is called an acquired right. And if you get a payment by your employer, which is considered to be an acquired right, that income, that amount of payments by your employer is immediately taxed as employment income. It's sort of a fringe benefit. If you don't have an acquired right, you will still be taxed as employment income if you withdraw it before you reach retirement age. Okay? So let's say you haven't, so this is employment income, but it can be treated also as capital income. Mostly it will be treated as capital income if you withdraw it all at once. right? That's if you take it out under the form of a lump sum, then it may be treated as capital income. But if it hasn't still been taxed as employment income, that portion that was paid by your employer, so there are two chunks. The one, the amount of the capital, it will still be taxed even at a later stage as employment income. And the capitalization, the valuation of the assets will be treated as capital income. If you receive that amount after reaching retirement age, it will be capital income, as I've described, or it can still be treated as pension income if you receive it under the form of a rent. So if you receive periodic payments, it will qualify as pension income. So this on its own, it's very difficult to understand and to explain. But sometimes the features are difficult to understand when you're looking at other countries. From my experience, sometimes I know that the client receives a pension, and I ask, but who pays it? Was it the employer? Did you pay it yourself? But is it mandatory or not? Is it because I just received an email saying pension plan? So they send me a brochure, and even the brochure sometimes, so it's from a practical standpoint, I find it very difficult sometimes to qualify it in one of those boxes. And I'm assuming this may lead to some litigation because sometimes it's difficult to explain as well. In my personal opinion, if it is mandatory, if you are paid upon retirement, and even if it is paid by a private entity, right? But it's retirement and it is a mandatory social security scheme, I think it should qualify as a pension. Well,
okay. All right. So the simplest scenario in that it's the variant that perhaps matches with what obtains here in Portugal would be if someone works for the government. So let's say they were a federal employee, they were a fireman, they were in the military, they worked for the government. Yeah. And it was an obligation. They had to contribute, and the government may have put something as well.
Yes.
And upon retirement, whatever the age is, and they happen to be here in Portugal, the distribution, not in one go, but every month or whatever the required minimum distribution per month for Portugal, whatever it is, that would be a pension that would match with Portugal's definition, more or less.
I would say so, yes. The fact that you're mentioning it's a public service and all of that, in my opinion, it should qualify as pension. It is upon retirement, and even if it would be debatable. The fact that you mentioned that it's paid periodically, I think, would settle the qualification issues. And if you want an HR, are taxed according to a specific framework, and general taxpayers according to the other. If you're an NHR, pension income, qualifying as pension, as you just described, should be liable to a 10% flat rate. Right. Problem with your scenario, I think, I don't have the entire 3D on back on my mind, but typically when you're paid from public service, there is no exclusive taxing powers on residency. There should be either exclusive taxing powers on source, or sometimes both countries can tax. So even though I would apply a 10% flat rate here, or according to law, there's 10%, there should be exclusive taxing powers in the US. So I wouldn't be really taking advantage of the regime here. So in order to take advantage of the regime, you should have pension from past private employment. In that way, exclusive taxing powers rest with the residency country, which in the case of the NHR should be Portugal, and you would be eligible for the 10%, right? This was what led Sweden to terminate the tax treaty with us.
Okay, so well, even with the scenario in which they were a former government employee, that it's fine from the US side. There's a way of recharacterizing the income, so we get to apply that 10% that we pay to Portugal against the US liability on a Form 1116 for those who are US taxpayers. Now, if it is that someone worked for a private sector employer, so no government at all, then that's different, right? So it would be viewed as potentially securities income, potentially employment income, at the point at which they take distributions, depending on whether they take it on a lump sum or over a period of time. Am I correct in saying that?
I think so, but let's recap. I would say if it is a mandatory pension scheme, which is the mandatory state, there's a binding ruling, again, only binding for the taxpayer, but there are several different components to the pension that a taxpayer received, and one and was paid by the UK from the UK, and there was what tax authority said it was a state pension, pension, which I'm assuming and which I consider doesn't really have to be paid by a state body, but it is mandatory pension, in my opinion, pension income. And if it is that state pension, you can receive it periodically, but I think because the law allows me to interpret it that way, you may redeem it all at once if it is the state's pension, and it won't change the qualification. Now, if it is not the state pension, then you enter in that argument of where it fits, and it depends. Have you reached retirement age? Yes or not? Yes, I have. So it's capital income or it's pension income, depending on if you receive it all at once or if you receive it in the form of rent. You haven't you haven't reached retirement age. So do you have an acquired rights? You will be taxed immediately. If you don't, you may be taxed a portion of it as employment income and the other portion as capital income. So very straightforward, as you can see.
Absolutely.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.